everyone. Welcome to the KE Report daily editorial on Monday, August 11th, chatting with Craig Hemke, founder and editor of TF Metals Report. Craig, as always, we're going to be talking precious metals, and well, there's a lot of noise, I guess, in the gold market after what happened last Friday with apparently tariff news and the immediate backtrack of that tariff news, which was interesting. Friday, the gold futures price shot up. The spot market didn't really do anything. GDX didn't really move. It was up, but barely. And then we got the news that, oh, these tariffs on gold bars probably aren't coming in. There was confusion on that. And Monday, we're seeing the futures market down and spot actually down as well. And GDX really not doing much. It's down just a little bit. We still have gold in a rising price environment. Gold is still at 3,400, but hey, very likely that Friday spike move could be at least a short-term top as traders now digest what else is to come this week, especially from inflation data. But Craig, what was your takeaway from the unfortunate tariff volatility, which seems to still be present in whatever Trump tweets about, but recently he's been a bit more focused on at least some metals, and gold was on his radar last Friday.
Just like the copper thing, right? Jeez. Yeah, and it was unfortunate because gold was already moving up late Thursday when it came out that Trump was going to put his own economic advisor, Stephen Mirren, onto the FOMC board for 6 months or so to replace Goon Kugler, who suddenly resigned a couple of weeks ago. And that was very gold bullish news because now all of a sudden we got 3 people voting FOMC members. So there's definitely that are pro rate cut and all that kind of stuff. So that was bullish news in its own right. But then Thursday afternoon, the Financial Times comes up with this story that they had found this ruling from the U.S. Customs and Border Enforcement, whoever the hell it is, that says, Manfra had asked their lawyer for clarification on Swiss tariffs, and they guys, it sure looks like gold's going to be tariffed. And anyway, I was telling people on my site, come on, this is bogus. If anything, it's a taco watch, a taco warning again. It'll change. All it takes is one tweet from Trump, and this has changed. So I sure hope you're not excited about it. Lastly, this is now the 5th attempt at the December contract to get above $3,500. It's like 5 months in a row, once a month. And the very next day, it gets reversed and slammed backward. So to think that suddenly this bogus tariff thing was going to be the thing that broke it out this time, it just was, I don't know, it was just all very frustrating because, again, it drives the narrative, and so now, why is gold down today? Well, because clearly the tariff thing, well, wait a second, it already fell Friday because of that. Yeah, I mean, you could come up with all kinds of reasons for any day-to-day action. It gets annoying. I will continue to focus on the big picture. I think the big picture is extraordinarily bullish over the next 8 to 12 months and try to just whistle through all this daily stuff.
Well, Craig, it's also, if we just widen the scope out to a couple of weeks versus just a couple of days, gold had been moving higher ever since the jobs report came in under expected, I think 2 Fridays ago. And to your point, it was already moving up all of last week before that tariff news even came into play. I'm impressed by gold's resiliency above the $3,400 level. And even last week, despite the pullback on Friday, was the highest weekly close of all time. So in the middle of the pity party for the fact that gold dropped just, a tiny fraction, a percent or two, people are missing the forest of the trees here. Like, we just had the highest weekly close of all time last week. And so when you look at the pattern of higher highs, higher lows, gold is still very much in a bullish uptrend. What do you think that sometimes the daily noise gets people so wrong-footed that they're missing, like you say, the big picture?
For sure, which is why I had made a decision, 12, 13 years ago on my site to not really focus on the trading so much anymore because it totally blunts your senses and creates your own bias against the long term. Well, it didn't do what I wanted it to do this week, and so I'm going to go off and do something else. Owning gold and silver, and you could even say this about the mining shares, I think is so important in this end times, if you will, this crazy period we're in with the monetary system and the debt-based monetary system and the screaming amount of debt that just keeps going higher and higher, and the amount of dollars it's going to take to service that debt. It's like I keep trying to remind I have people and friends that I have to remind this of over just in a discussion back on Saturday. Gold's expensive. It's going to go back down. I'm like, I don't know. Yeah, maybe it's always going to fluctuate. But all I know is 10 years ago, it took $1,100 to buy an ounce of gold. And now 10 years later, it takes $3,300. Has the gold changed? I mean, is the gold more efficient? I mean, does the gold do more than it ever used to do? No, it's the same thing. It's just your dollar, your purchasing power has been depreciated that much. And as long as that trend continues, and there's no way it's not going to continue, then even on the monthly and annual chart, you're going to get higher highs and higher lows. And so I try not to get, and it's not easy, but I try not to get too fixated on the day-to-day stuff because, again, it's so easy to jade how you view the bigger picture.
Well, let's view it from this year in the sense that the gold stocks have been outperforming gold. And recently, GDX was making a breakout. We've seen GDXJ making breakouts, SIL breaking out, all while gold has mostly been channeling sideways. The futures, yeah, it had that breakout last Friday, but again, that pretty quickly reversed. The spot market gold, that hasn't broken out in the last 4 months as it's also channeled sideways. But again, the stocks are outperforming right now. So what does that environment mean to you?
I think it's fantastic, actually. What's a GDX is up 68% or something year to date. And there are several individual mining companies. Remember, we talked about this back in January about if you're willing to do your homework and try to focus your attention on the well-run companies that manage their costs and have wide margins, you're going to do better than just the passive investing of buying the GDX. And there are a number of companies that are up, heck, I know Kinross, just off the top of my head, is up like 99% year to date. I think a lot of that, to me at least, is a reflection upon people adjusting to the reality of where the gold price is. And I'll give you an example of that. Agnico and Newmont both had these great quarters they reported in late July, but in the week that followed, both stocks went down. And the gold price was falling because the dollar was going up and Powell was being super hawkish at the FOMC and all that kind of stuff. Well, all that changed with the BLSBS report back on Friday the 1st and all the downward revisions and people figuring out it's all garbage. And, if the number's been accurate in the first place, Powell would have already cut a couple of times. And so I think a realization hit, just in air quotes, the market last week, beginning on Monday, that the gold price maybe isn't going back to 3,000 or to 2,800 or something. So where people were selling the news thinking, okay, you're going to have to prove it to me again now in the third quarter that you're going to make this much money. People looked around last week and said, wait a second, we're already a third of the way through the third quarter, and I don't see gold going back down now. And so, boom, the floodgates opened, and up goes Newmont, and up goes Agnico, and up goes, all the ones that report earnings last week. And so I think that's what's driving now that alpha, if you will, that you can find in the miners, is that gold has proven that its rally is sustainable and for sustainable reasons. And now investors are starting to do some math and going, these things might still be cheap. And yeah, again, what a great week last week. Highest weekly close in the GDX since like 2011. Terrific.
Well, Craig, I want to dig in on this idea a little bit more about the earnings and what we saw, because initially Newmont popped on the news before it sold off, and so did Kinross, so did Agnico Eagle. But last week we saw Hecla and Core go up double digits 2 days in a row. They had Core was up 14%, Hecla up 18%. The next day they went up 2 or 3%, and that was still on Friday when gold was pulling back. And they have a nice mix of both gold and silver. They're not truly silver miners, they're not truly gold miners. They're kind of hybrid precious metals, and you have a higher silver price too. And I keep asking people, I've asked probably a dozen people, are these earnings reports already priced in? And robotically, people say, oh, yeah. The markets are forward looking, Craig. They're already priced in. And then we see the earnings come out and they're not priced in because they pop a lot higher. So what do you make of the fact that people are still underestimating the earning potential of these producers?
And I think it gets back to that other story. I mean, it's the expectation that, this gold's now expensive. And okay, fine. Yeah, I guess if you never paid any attention to it at all and you look at it like as a tech stock or something, but it's not expensive. It's a reflection of the weakness of the dollar. It's also, people look at silver and go, I mean, how many times has silver had a weekly close north of 38? I mean, ever? Like six? I mean, I'm just guessing. I don't know, once or twice in 1980 and three or four times 15 years ago. So I think people are in disbelief of that. It is as those prices are sticky and keep moving higher that people start going, wait a second. None of this is priced in. Now, I will tell you, I mean, I was doing this on my site the day that Hekla's earnings were going to be announced that afternoon. And I was like, look, Hekla's like Newmont or Barrick. You go back 30 years and find the same share price. Not that it's been diluted with secondaries and stock splits. Same share price 30 years ago, which means it's maybe a trade, not an investment. And you look at it now and you can see where the levels of resistance are that are coming up. CDE, though, core is another. That thing was two. I couldn't believe it. I mean, I gave up on that stock years ago. I just don't even follow it. But I pulled up a monthly chart or a weekly chart, whatever it was, and I was like, you go back not even 2 years ago, it was two. 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 It's now almost 12. I mean, we're talking about Bitcoin. That's fantastic. So there's definitely leverage there. There's definitely an awakening that is occurring. And if I'm right about precious metals prices, not like this week, but if I'm right about where they're headed because of what Trump and Besant and everybody else are telling you about what they plan to do next year, then it's definitely not too late to climb on board the train.
Yeah, isn't it a different picture when you pull up those really long-term charts? You want to talk core? It was 12 something back in 2021. You go back to 2006, it was up in the $73 region. Now a lot has changed since then, but Craig, we're also seeing these gold stock moves while the stock market is going up. The Nasdaq, the S&P, those are pretty consistently hitting all-time highs as well. How does that play into what's going on in the gold stocks, or is that a totally different story?
Oh, I don't. I think they're kind of tandem in a way, and you certainly see it sometimes when gold and silver are up strong, but the S&P is down 1%, and you're like, well, gee, look at these mining shares open strong, and then they were sold off all day. Well, they are shares after all, right? And we always run the risk that in any kind of big sharp pullback, like in equities, general equities, like we had in early April, that everything gets dumped. You know, and what'd silver go to? 27 or something just because it had a bid, you know, and everything just gets washed out. And you always run that risk. But, and I don't mean to be Pollyannish, you know, pie in the sky, head buried in the sand, whatever metaphor I can come up with. But it seems to me in the bigger picture that we're in that kind of crack up boom phase of the Austrian economics where there's just so much fiat currency being created, not just in the US, but around the world, just to service the debts that continue to expand almost exponentially. And that currency eventually just gets out in the wild and chases all different assets higher. And so there will be pullbacks, and I know there are a lot of smart people. I know several that are thinking that maybe the S&P is rolling over, and maybe it is. And that could certainly be a risk in the short term to everything. But I would imagine it'll eventually just bounce back like it did in April. And that just then that makes the case if the metals and the shares sell off, they'll probably just bounce back too.
Well, Craig, you'd mentioned in passing the high weekly close for silver, and I don't feel like we've given silver really enough airtime over the last couple of weeks that it deserves. We spent years waiting for silver to get above 30 again. It briefly eclipsed it during the silver squeeze back in 2021, but it's been a long time coming. Silver at 30 seems like a low price now. Then it was $33 resistance. We got to get above that. Then it was 35. It's a line in the sand. It's important on the weekly and monthlies. And silver's at 37 to 38 the last week or two, and it seems like very few people are noticing, but this is a level that it hasn't been at for a long time. And to the point you're making about we're already a third of the way through the third quarter, the silver companies that actually produce silver are raking it in now. That is such a huge move in their margins. Do you think people are discounting the strength that silver's been showing and the strength that the silver producers are going to be showing in the third quarter?
Yeah, you wonder. And again, it gets back to can the price hang in there? I saw a thing last week. I think it was Peter Spina, I think, had a chart of the history of silver's 200-day moving average. All right, so there's something kind of obscure. Do you know it's the highest it's ever been? It's like 33.30 or 33.40 or something like that is the current 200-day moving average of silvers. That's something to chew on, right? I mean, so you think, well, how far might it pull back? Well, maybe it'll pull back to its 200-day moving average. And if it does, it's still 33, which is it's still, even at that level, a very wide margin. So anyway, again, that's kind of what I'm falling back on, is that there's this, again, this reluctance to believe that these rallies, these prices have staying power. And again, I understand. I mean, remember, we've talked gold for the last 25 years has had maybe 3 years where it had a 25%-ish gain. One of those 3 years was last year. And so it's logical to expect that, and I wrote it in my macrocast this year, maybe this should be more like the average return of 10%. Well, here we are up 25 again. We could just go sideways for the whole back half of this year and post a 25% gain on the year and be like, holy smokes, that's almost unprecedented. But everybody just thinks, everybody, I don't mean to generalize in this way, but I think the preponderance of analysis is that these prices are too high and that they got to come back. And so investors just don't want to believe it. Now, the other last thing I would add to that, and we've discussed this before, when investment banks start raising their gold price target, this is important. This happened last Monday. Citibank had come out in June and said, we think gold's going back to 2,800, demand is slowing and all this kind of stuff. And gold went down on that news. Last Monday, Citibank reversed course completely and said, no, we think it's going to 3,800 instead. Well, I don't know how many analysts they have in their equity division that follow precious metals, but they're not going to pick their own price for where they think earnings will be. They're going to use their precious metals desk. There's those analysts. And if they start basing their 2025 and 2026 earnings projections off of $3,800 gold instead of 2,800, well, that changes everything. Now all of a sudden it's a screaming buy, and it goes out on the squawk box to everybody sitting there at their desk. And so this staying power, whether it's perceived at the institutional level or retail level, that's the key. And that's what changed last week after that terrible jobs report. And that's why we got such a big rally.
Hey, fair enough, right? The price does keep moving up. Remember, it was 1750 back in 2022, and it's consistently rose. It's actually been a much better rising environment than that spiking environment. But whenever we talk silver, look, we do note that it is a much smaller market than gold. And a lot of the time you hear people coming out of the woodworking saying, short squeeze is going to drive it higher. Short squeeze is going to spike the price. Unfortunately, when that has happened in the past, it has led to a top in the price. But Craig, you seen anything in the COT reports that say a short squeeze could be coming, that a short squeeze has happened, anything to that effect?
Well, from a commercial squeeze standpoint, remember we saw that a little bit in gold between about February and May-ish, and then we've gone sideways since. But the commercial short position in gold kept declining in that period while price was rising. It was that buying, because you got to buy to cover your short, that was driving price higher. That has since kind of stabilized and subsided while price has been going sideways. In silver, it's more of a function of speculator demand. Remember, again, another thing we've talked about in the past, how silver, got to have an inertia applied to get it against it, to get it to move. It'll just sit there and stare back at you for the longest time, and then people just give up. But when it starts breaking out and rallying, it kind of creates its own virtuous cycle. Hey, look, it's going up. Oh, we ought to buy some more. Hey, it's going up. I got FOMO. I better buy some more. And then you get these runs from 27 to 39, from April to July, right? So you got to watch that sentiment, and a way you can kind of gauge that positioning is through the commitment of traders reports, which are useless unless you have kind of history to base them off of. You can see the positions and go, oh, that's nice. But if you don't know the history of the position, it doesn't tell you much. And so what can I tell you? The survey from last Tuesday, the 5th, was published back on Friday, this last Friday, the 8th, and it revealed that in the broad category of the large speculators, they have their smallest net long position, because they're almost always long. They have their smallest in size net long position since May the 20th. Where was price back then? About 33. And where are we now? 38. Drill down into the components of the report. The hedge funds now have a net long position under 30,000 contracts. Okay, great. What does that mean? Well, for perspective, that's the smallest hedge fund manage money, whatever you want to call it, net long position in COMEX silver since May the 13th. And again, it peaked out like at 50,000. Now it's down to 30,000. Peaked at 50 when we're at 39. It was last at this level, we're at 33. So you could make the case that even though price is hanging in there at 38, the playing field is as uncluttered as it was when we were at 33, which again doesn't mean for sure that the price is going up $5 from here, but it shows you that there is room, if you will, for speculative buyers to come back in of the futures contracts and push price back higher. So it's possible. It's a very good seasonal time for both metals. Should be dovish talk from Powell at Jackson Hole and then into September. So it's there for the taking. We'll just see if silver can move to new highs.
Well, Craig, when you look at both gold and silver looking forward, you brought up some of the macroeconomic data on tap there with Powell's speech, but also looking ahead to September with everybody expecting a cut. What economic news actually does matter for the precious metals now? Because we were remarking off mic that for a while we were hearing about all the geopolitical premium that was built into these precious metals. But then when those stories fade to the back pages of the media, it's like, where did that premium go then? And then when you look at economic data, one day it's a jobs report, another day it's an inflation warning, another thing it's, the Fed has replaced one of the goons. But what actually matters for the precious metals? What are you expecting to move the needle as you look ahead?
Well, when it comes to economic data, it's more of a secondary impact for the precious metals. You got to watch that economic data and take it point by point and to see how the bond market and the dollar index respond. Because again, if you're creating a backdrop of economic weakness, which is what that jobs report, in the revisions were really terrible, or the PMIs last week that showed so much weakness in the service sector. Not only, the manufacturing sector was even worse back on the 1st of August when those PMIs came out, but the service sector were really weak last week too. And so you have this collection of data that has this impact on really the bond market first, but then that impacts the dollar, and then all of that collectively impacts the machines that trade gold and silver futures. What you're getting though is this more broad picture of a weakening economy. Some people already now starting to suggest if we'd had this jobs data from back in, May and June, that people would be like, wow, yeah, we might be slipping into recession here in the third quarter. And we probably are. And again, that goes back to, again, the macrocast this year about when the yield curve uninverts, which is what happened in the U.S. very late last year. That's typically right before the recession begins. So putting it all back together, you have these individual data points that start to, collect in your mind as proof that there's this happening, which then prompts, perhaps, at least seems like it, some rate cuts that are coming, which then prompts maybe some weakness in the dollar, which then prompts the machines to buy some gold and silver. So I don't know if I answered your question, Chad. Hell, I've been talking so much, I don't even know what I've said. But
close enough, Craig.
Thanks,
you know
Corey.
what? We're going to be watching for inflation data this week, and
This
quite
week.
frankly, a lot of eyes are still on what the Fed's going to do and the expectation of rate cuts. And I think everyone has become numb to that whole recession call because it seems like it's been ongoing for the last couple of years. And whenever people start to forget about it, that's sometimes when it comes. But hey, look, the fact of the matter is the precious metals are still doing very well. The stocks are doing very well. That's in an environment where also the broad averages are doing well, also led by tech. Just an interesting world we're living in. But as much noise as we get out of the White House, it seems like whenever it hits a market or spikes the market, you tend to want to be on the other side of that trade if you are a short-term trader. But Craig, we'll chat with you again in the next couple weeks. And Craig Hemke is the founder and editor of TF Metals Report. Always great chatting with you, Craig.
Have a great week, guys.